Hi there. Today we look at the concept of current assets. Let's share the screen and get going. Righty, so we've already spoken about assets, and we said that assets are items of value that the business buys or purchases. So today we are specifically going to look at current assets and what current assets mean. We will always come back to the accounting equation because it's such an integral part of this subject. So previously, we've discussed non-current or fixed assets, which are land and buildings, vehicles, equipment. Today, we will be spending time on the explanation of current assets, and we'll explore each of the accounts that are listed as current assets. Now, what are current assets? They are either cash, money already, or can be converted to cash within a year. So that is very important. Either cash or can be changed or converted to cash within a period of 12 months. Now, this one is quite interesting. Current assets, when we open our current asset accounts or list our current asset accounts in our general ledger or our trial balance or later on in our balance sheet financial statement, we will always list them from the least liquid to the most liquid. Now, what does that mean? This means that we list them in order of how easily we can convert this specific asset into cash. So from the one that's least likely to be converted into cash to the one at the bottom, which is already cash. And if we take from left to right, you will see that cash are already cash accounts. The names are already telling us that it is money, cash. The first two, we still need to convert to cash. So let's quickly have a look. The least liquid of them all is trading stock. Now, trading stock, if you're in grade 9, you will deal with that the whole of grade 9. If you're still in grade 8, you just need to be aware of the concept of trading stock. So trading stock are those items that our business, and remember, we always look at it from the business's perspective. So items that our business will buy from wholesalers or factories or manufacturers, and then we are going to sell those items in our shop or our store in order to generate a profit for the business. So this is what we call, those items are called trading stock. So things that our business buys in order to sell it at a profit to our clients. Now, can you see, when we have the stock on our shelves, obviously the trading stock is not cash, but at the moment we get a client coming into our store and now paying for that trading stock, the client takes the stock and in return gives us cash or money. So we are converting, our business is converting its trading stock into cash. All right, the second one is debtors, or you might have had people or clients to whom our business sold on account or on credit. Again, you'll be dealing with the debtors concept in grade 9 onwards. So a client will come into our store, and there's a whole process before that where we do credit checks before we open an account for that client, allowing that client to buy on account or on credit. So it doesn't just automatically happens. But say that process has been worked through and the client has been approved and now has an account with our business. That client will come into our store, take whatever stock they want or want to buy, and then they will go home. They will not pay for it on the spot. They will have a contract with our business, either to pay the money that they owe on this credit purchase or account purchase over a period of 3 months or 6 months or 12 months. So the client has taken our stock and the sales transaction has taken place. All that now needs to happen is for the client to pay back the money. They or those clients owe money to our business. While on the concept of debtors, for many people, this sounds a little bit funny. And how can the fact that somebody owes money to our business be regarded as an asset, something of value to our business? It almost sounds as if it should be rather a liability. Now, we always say that business people, entrepreneurs, business owners are very trusting people, and we are positive people. We believe that things will work out the right way. So we believe and we trust that that client to whom we sold our stock on account or on credit will indeed pay his or her debt. And the reason why we also say that is because there's a whole process that goes before, or that is handled before we even allow the client to buy on account from us. So because that process is in place, because we've done credit checks and all the rest, now we're allowing the client to buy on account from us, we believe that that client, the debtor, will indeed settle his debt with our business, or pay back the money that he owes. And therefore, in business terms, debtors, the money that the debtors owe to our business, is indeed regarded as a current asset. Now, why do we say that trading stock is less liquid than debtors? Trading stock, there's no transaction yet. The stock or in our store, it's displayed on the shelves. We still need a client to come in to like that specific item or this one, then come to the till and make the decision to buy those items from us. Only then a sales transaction will take place. Debtors, on the other hand, the sales transaction has already taken place. They've already come into our store. They've taken the stock that they wanted and liked. They came to the till, they signed the agreement that they will pay us later. So this is a bit more liquid. The debt of a debtor we regard as a bit more liquid than the trading stock asset, those assets that are the trading stock items that are still sitting on our shelves. The last three on the list of current assets are all cash or money accounts. So you can list them in any order, because they're all the same, they're all cash or money. So if we talk about the bank account, this is literally the cash or the money that our business has available in its bank account at a commercial bank like Absa, FNB or Nedbank. Many businesses have current accounts, or in the old terms, we call them check accounts. That is just a type of account that's usually opened for business purposes specifically, but all in all, it's a bank account, and the business keeps its money in that bank account. Usually also money that's readily available for payments or things that the business need to buy. So this is then an asset to our business. Current asset account is cash float. Now that is the money that we will put in our businesses till, the cash register, at the start of each day, or perhaps at the start of each shift. If we have a retail store and we've got cashiers that work shifts, there will be some money that we put in the till, so that when the clients come and they pay with cash, maybe they pay with R100 note, but we need to give them 37 Rand change. That change is then given from the cash float. A small business might have a cash float of 50 Rand or 100 Rand, also depending on the type of business. Do we have a lot of cash customers coming in where we need to give them change? All of that will determine the cash float amount in your business's till or register. So obviously it's money, it is cash already, and therefore it is a current asset. Then the last one that we're looking at is petty cash. Now, often you will find in businesses or organizations or shops, they will be in the safe or in a safe place, usually with the secretary or one of the financial or administrative personnel, a little money box that's obviously kept safe with, again, a bit of cash in that container. And that's often used We call it ad hoc payments. Those are things that we randomly and quickly have to buy or pay. So let's say it is now time for coffee break today in our business, and we get to the little kitchen, and all of a sudden somebody realizes, but oh goodness, there's no milk left. All the milk is finished. Then you would take, and the responsible person, somebody will be responsible for that, to manage the petty cash within the business. Let's say it's a secretary, she will give somebody 50 Rand from the petty cash to say, listen, quickly run to Spar across the road and just get us a liter of milk so that we can have our coffee and tea. And then that person will come back with the slip and any change that's left over from the 50 Rand, and then the person who is managing the petty cash will at some stage do something which we call restore the petty cash and again get more cash in, so that there's always money available for those small payments. If you move on to grade 10, you will learn more about a specific journal for petty cash, the petty cash journal. But that is in short what the petty cash, let's say, meaning is within a business and what we do with the petty cash. So that's for small payments. Previous or many years ago, when people still made a lot of photocopies or bought stamps, when they had to post some letters, you would send them with a little bit of money from the petty cash to buy a stamp or to make a photocopy. The need for the petty cash or a petty cash amount is still there. And once again, big businesses might have a petty cash of 1,000 or 5,000 Rand. It depends on the type of business and the needs of the business. Small business, maybe 50 or 100 or 200 Rand. And that brings us to the end of current assets. Hope this makes a bit more sense now.